Fabio's poor. He's selling his butt tonight. What a loser, but of course, bro. Welcome back to Strongman Personal Finance. I was just kidding, Fabio. Google stock is amazing. It's a great stock, great company. Anyway, we got to talk about Google. Alphabet Incorporated. It's down 9.6% on recent earnings, and it's down 2% after hours. And honestly, this company could drop to $20. I mean, it's just going to zero, bro. So why is the stock dropping? Well, let's go check out the most recent earnings, the third quarter 2023 results, published October 24th, that's yesterday. What happened? Well, if we go straight to the numbers, we can see on the top line, they've increased revenue 11% year over year, which is pretty freaking good. Okay, that's pretty good for a giant company. Operating income is up pretty significantly as well, and they posted an operating margin of 28%. Now, this is better than it's been for a decent amount of quarters. If we go look at their prior operating margins, well, it's roughly in line with it, but they're definitely right in the realm of possibility. I mean, they're right in the realm of normalcy. Now, look at the past. Before, in the past, they never really breached 25, 26%. Now they're posting 28% operating margins. However, there is a very key thing that I'm going to show you in a second. That's important, but we'll get to that in a second. They did some accounting shenanigans to increase their profits, and I guess you can do that, okay? It's accounting, bro. So let's look at the disaggregated revenue. Google Search and other is up. Let's see. Let's do the math here. So we take 44,026 divided by 39,539, up 11%. YouTube ads is up, which, I don't understand that because my ad revenue is not up. But YouTube ad revenue is up 12.5%. And then Google Network actually went down a little bit. But overall their revenue increased. And then they have, here's the big one right here, Google Cloud. Okay, so Google Cloud is I guess everybody has these insane expectations for Google Cloud. Now, if we look at the growth, it's impressive. The total revenue growth for Google Cloud is, look at this crazy math. This is what happens when you're a CPA. You can do crazy math like this. Google Cloud's revenue was up 22.5%. Apparently, that wasn't good enough. Apparently, people were expecting Google Cloud's revenue to grow at, I don't know, I'm just pulling a number out of my butt, 28%. That's what I saw in an article somewhere. But it's still pretty impressive revenue growth, 22.5%. It looks to me like Google's doing fine. I don't see major issues here. Yeah, I mean, I guess the cloud revenue disappointed, but that doesn't mean this is a trash company. Their margins are fantastic. Their revenue is still growing at a healthy clip. I don't see a problem here. They've also cut employees. We can see a drop in employees, which helps margins. And we can see some of where the profits actually came from. Now, here's what really kind of shocks me here. Most of their operating income, basically all of it, comes from Google services. The Google Cloud, which is the reason that the stock sold off, because it didn't grow fast enough, it's barely profitable from an operational standpoint. It just tipped over into profitability. So basically, Google services just carries everything. That's all it does. And then they have these other bets here, whatever that is, a bunch of random stuff they're probably investing in that may produce results in the future. And then corporate costs unallocated. But overall, Google services, that's the big daddy. Google Cloud just barely makes any money at all. This isn't like Amazon where the vast majority of their profits come from their AWS. This is not the case with Google, okay? So I guess Wall Street, this could have been 300 instead of 266. Very disappointed. Now, here's some additional information. Here's where there's a little bit of shenanigans going on. So, of course, they reduced their workforce, which is fine. You can fire people whenever you want. At will employment. It's how the world works, okay? That's why you should have a freaking skill so you can go somewhere else. Here's where I get a little suspicious. Change in useful lives of our server and network equipment. Now, in accounting, when you buy a long-term asset, you have to either depreciate it or amortize it. And all that means is you're spreading the cost of the asset over its useful life. For example, if you spend $1,000 on an asset and you think it's going to last 10 years, it has no salvage value, then you assume that you're going to expense or depreciate, non-cash expense, $100 per year. $1,000 over 10 years, you're expensing $100 per year. In accounting, the useful life of an asset is determined by judgment, okay? This is where accounting can it's not always a science. There's some judgment that goes into it. Basically, the company and the management, they figure out what is the use, how long is this equipment going to last? How long are we actually going to use this equipment? And that is subject to change. And here's what Google did. In January 2023, we completed an assessment of the useful lives of our servers and network equipment and adjusted the estimated useful life of our servers from 4 years to 6 years. What does that mean? So instead of expensing something over 4 years, you expense the same amount over 6 years. So if you spend $1,000, instead of splitting it 250, 250, 250, you split it over 6 years, whatever the freaking math is. I'm not going to do it in my head. So it results in a lower expense on your income statement, which makes you look more profitable. Do you see what they did here? They increased the estimated useful life of their servers to help boost their profitability, okay? Same thing with network equipment, from 5 years to 6 years. This change in accounting estimate was effective beginning in fiscal year 2023, and the effect was a reduction in depreciation expense of $977 million and $2.9 billion, and an increase in net income of $761 and $2.3 billion. That's freaking crazy, okay? And yes, you need to understand this stuff, okay? Because, their profits went up. Yeah, because they changed accounting rules. I mean, at the end of the day, they still would have been profitable. It's fine, whatever. But you got to understand what's going on here. And companies do this, and you got to be wary when they do this. It's like, why are you doing this? Are you doing this because you really think this stuff's going to last longer, or are you doing it to make yourself look more profitable? That's all I'm saying. But I'm not saying this is not fraud. This is a change in judgment. But well, that's neither here nor there. Something to pay attention to, though. Now, if we look at the balance sheet of Google McDougal, let's see. Cash is up. Marketable securities is down. So it looks like they have more liquid assets. Okay, they have $119 billion of cash and cash equivalents. Let's look at their total debt. Their total debt is $123. So they could almost pay off every single dime of debt with their cash war chest. Probably not the best idea, but they could do it. Okay, pretty impressive balance sheet so far. Total current assets $176 billion. Over 86 of current liabilities. Not going bankrupt. Okay, let's look at their long-term assets. Non-marketable securities, whatever that is. Deferred income taxes. That's taxes they're going to save in the future because of accounting differences between tax and books. Property, plant, and equipment, they purchase more, but now they're spreading it out longer. See, first PP&E goes, servers, equipment. It goes to the balance sheet. And then if they didn't buy anything else, you would start to see the number go down because this is the book value. This is net of depreciation. But they depreciated assets and then they bought even more. So they're buying a decent amount of assets. Leases, really no change. Intangible assets, negligible. Goodwill, looks like they made either a tiny acquisition perhaps. But overall, they have a ton of long-term assets. And especially relative to their long-term liabilities, they basically have no debt, okay? This company is doing fantastic. The only thing that I noticed in this report was the accounting shenanigans, which it's not illegal. It's a change in judgment, and accounting is based on judgment sometimes. Not all the time, but sometimes. And the Google Cloud, the stock sold off massively because of Google Cloud. I mean, what Wall Street's probably doing is they're baking in insane expectations. Oh, Google Cloud it's going to be like AWS, bro, and it's going to be all the profits are going to come from there. So we got to sell the stock if it doesn't grow over 22%. I mean, Google's doing fine. I would not stress the cloud, at least in the short term. This company is doing just fine without the cloud. But, of course, everybody wants it to grow as fast as possible. So I don't see any red flags on the balance sheet. Let's look at some of the comparative analysis for expenses. So we know revenue went up 11%. Cost of revenues went up 10% maybe. R&D is up a tad bit. Sales and marketing is down. And general and admin, even though they fired people, their general and admin expenses are up a little bit. And their total costs and expenses are up a decent amount. But still pretty decent income from operations. Their revenues grew faster than their expenses, partially due to the change in accounting for the depreciation. I mean, the company did fine. The earnings are fantastic. I mean, look at the cash from operations, up over, $7 billion in a quarter. Let's see if there's any funky stuff up here. So we can see depreciation went down. Look at that. Look at that change, bro. They bought more assets, but their depreciation is lower because of their accounting estimates. Stock-based compensation is up, though. Interesting. Let's see. Accounts receivable. Yeah, really nothing crazy on here. Let's see what they're doing for investments. So they bought a little bit more property, plant, equipment this quarter than the prior year. Didn't plow as much money into marketable securities. Let's see. They spent $15.7 billion buying back stock in a quarter. In one quarter, they spent $15.7 billion buying back stock. That's a lot of money they're plowing into buying back stock. Holy freaking crap. Okay. They issued a little bit of debt, but then they paid off more. So overall, I mean, they're buying back stock. Their profits have increased because of accounting, but even then, their cash flows have increased as well. That's a good thing. I don't see any major issues, okay? Besides the whole cloud thing. Oh my God, the cloud. But, Google is not just the cloud. I mean, look at some of their products. Android, Chrome, this is like a monopoly. Hardware, Google Maps, another monopoly. Google Play, I don't use that. Google Search, that's a monopoly. YouTube, that's basically, what else do you use besides YouTube? Rumble? This thing is a freaking beast, okay? So that's kind of my thoughts. Not the worst thing in the world, but what can you do? I wish I owned this stock. Oh, wait, I do. In VT. Oh, here we go. We have revenues by geography. So, as reported, they had 9% revenue growth in the United States. They had, emerging markets, East Asia, I guess. I don't even know what these freaking categories are. Why can't they spell it out, okay? Just whatever. So, most of their revenue growth has actually come from international, not from the United States. That's pretty funny. International, bro. It's trash, bro. Hey, nothing bad to say about Google McDougal. So besides the accounting shenanigans, I really don't have anything bad to say. What are your thoughts on Google Cloud? Are you upset? Were you expecting 1,000% revenue growth because of AI? Is that what you're expecting, ladies and gentlemen? Sorry. Cheers.